Hello, agentpreneurs, and welcome back to the Daily List Report. I'm Randy Shiozaki. I am your host and one of the founders of ListReports. If you don't use ListReports, you should. If you're an agent, we've got 300,000 of them across the country who use our free products. Go to listreports.com and sign up for free. While you're here, of course, if you like this content, please consider subscribing and click the little bell so you're notified of all of the future episodes that we have here. So today I have back on one of my all-time favorite guests, George Ratiu. He's senior economist at Realtor.com. Prior to Realtor.com, he was at the National Association of Realtors for 11 years, and he's covered all sorts of topics. He has such a great perspective and a background on what's going on in the industry. He's actually was on twice before, so episode 96, Curveballs Ahead, and episode 53, What the Data is Telling Us. Definitely check out that content. I'm gonna pull up one more thing while we're here before we bring George on. While you're here, again, George is senior economist at Realtor.com. I have up on screen right now their YouTube channel. Definitely check it out. Definitely subscribe to that so you don't miss any of this content. We're also going to talk a little bit about some of their research reports that they have. So they put out a monthly market summary. We'll link to this below. It's really simple, realtor.com/research. And if you scroll down to the bottom of the page, there's a nice little section here that says sign up for our mailing list to receive the latest data and research. Definitely consider subscribing to that newsletter. Again, we'll link to all of this below. They publish so much great information and data, which I think is really critical for all of us in this industry to understand what's happening, because it's going to help you formulate your strategies for what to do as the market continues to change and evolve. But enough of me. I'm going to bring George on right now. George, welcome back to the Daily List Report. Thanks for being here.
Thank you, Randy. It's great being with you today, and also, of course, joining the agents who are going to tune into this.
Absolutely, absolutely. I know from the comments and anecdotally the feedback I've gotten that this is a topic that everybody really needs, right? They really need to understand. And it's something that, as we've talked about before, George, is a little bit scary for people, right? Data can be manipulated in all sorts of wacky and weird ways. And, the same data can be presented in two different ways and you can draw two different conclusions. And so I love having you here because I know that you have a great head on your shoulders. And most importantly for me, you have a great perspective, right? In terms of what's happened over the last, couple decades, not to date either of us, right, but of this industry, and that perspective I think is extremely useful. So, George, why don't we kick it off here? You're a regular on the show. You've got all the street cred I could ever imagine or hope for in a guest on this show. But why don't we talk a little bit about your latest reports, what you're seeing in the market, and then we'll sort of jump in and riff on some questions. How's that sound?
Absolutely. Sounds great.
Awesome. All right, George. So what's going on in the market right now?
So what we're seeing really is a market that, considering the fact that we're in roughly mid-September, right, a time in which historically we saw demand begin to taper off, activity begin to decline, we're still in an unusual market from that standpoint this year. A lot of that pent-up demand, obviously due to the lockdown from early spring that sustained activity in the summer, is there, and it's there quite strongly. In fact, what we're seeing is buyers, again, fueled by, as we chatted before, by these incredibly low mortgage rates, are actively looking for properties, are actively looking to buy homes. And we see that in several of our indicators. So we have our housing recovery index, where we've been tracking on a weekly basis indicators for demand, supply, time on market, and prices. And we're seeing demand still rising. The index itself, the overall index, is about 7.4 points above the pre-pandemic value back in January. So it tells you that the housing market has had a very nice, strong recovery. However, the index is also down 1.5 points from last week. So we are beginning to see the first signs of a moderation in activity, a lot of it driven by supply. And when we basically look at the inventory situation, inventory is still accelerating on a downward trend. Basically, homes are getting snapped up, many of them as soon as they come on market. And the supply-demand imbalance is now really pushing prices strongly up. We're over 11% higher than we were a year ago with listing prices, which frankly is significant. I mean, that's the strongest pace of growth in quite a few years. And importantly, and I think for first-time buyers especially so, With mortgage rates this week, today, in fact, Freddie Mac came out, mortgage rates 2.87 for the 30-year fixed. The 11%, over 11% price acceleration is beginning to actually dent the benefit that a lot of first-time buyers would get from these historically low rates. So to me, that's a sign of concern, especially as we head toward the slower time of the year, right? The colder months when we expect activity to decline. And just as concerningly for me, the Mortgage Bankers Association came out with their monthly mortgage availability index. And what they showed for August was that the index declined. Was the second month in which it declined. So again, looking forward, I see those as being some early possible signs of moderation in activity. But for now, September still looks quite well. The one thing I would say to your point about where we are in the market today, the one area that is still not keeping up with the pace of demand has been construction.
Yes.
And we saw this week, we had new construction numbers came out, permits, starts, and completions were down from the prior month in August. The good news is most of the decline was driven by the multifamily space. It's obvious that in the multifamily apartment space, builders are a lot more cautious and faster to react to market changes. Single family permits and starts were up. They were up really high level. In fact, when you look at starts, they finally crested the 1 million mark annual pace, which says volume. So builders are obviously recognizing that this market is still hot, that buyers across generations are very much pursuing home ownership. So they are responding. Of course, from their standpoint, they have some headwinds. Lumber costs are rising. They still have shortage of labor. And even in terms of land, some builders are citing rising costs. So all of these are basically coming together to tell us that the market is still rising strongly, but we're getting some clouds on the horizon.
Interesting. So, George, I want to make sure I understand a couple of these things. Okay, the first thing you said speaks to this idea that I think a lot of people talked about in early sort of COVID days, right? Which was kind of a shifting of the summer, right? So that normally really active time where there was still activity, clearly, that might shift a bit to the fall. And now in a lot of markets, you know, the considerations that typically exist around school, right, are a little bit different right now. So are you saying that shift has occurred? I mean, that there's a lot more activity clearly now than there was a year ago or typically during this time. But that said, we would still expect it to slow down a bit as we get into the winter months.
Yes, that's certainly where I'm going with this. And as far as the seasonality, yes, there's a definite shift. In essence, what we saw in the summer, very strong activity, driven obviously by all these folks who had plans in place during the spring but had to postpone them. In addition to so many buyers whose plans basically were either accelerated or they created new ones as a result of this new environment in which we find ourselves, right? As we chatted before, when we have to not only live in our homes and cook and raise kids if you have a family, but we also have to work there, we have to exercise. All of a sudden, we've discovered that whatever homes we bought were not exactly ready for this kind of environment. And with companies across the country having given employees a much longer horizon, right? So many companies have announced already that their remote work policies will be in effect until next summer, possibly next September, which I think was a tremendous move because it, in a sense, freed employees and workers, to those who could at least work remotely, to look at alternatives. So this has actually just driven even more activity. And to your point, the school year, which traditionally signals, sort of the slowdown, right? Towards the tail end of August, as a lot of schools across the country begin, you see activity drop off markedly. This year, for one, we had a lot of school districts who were, even towards the tail end of August, was still trying to weigh their options. Do we open full-time? Do we open online only? Do we try a hybrid approach? So with that, obviously for a lot of families, the dawning came that there wasn't as much need to be, in a sense, rushing on one hand to close before September because, hey, there's
Yes.
still a little more time, so keep
Right.
looking, especially in this environment where you can't find the right home, for many people's budgets.
It's very difficult.
And so that's what we're seeing. Yeah, that's what we're seeing in the market.
Interesting. Now, the other piece of this, and I love this because I get to sort of be ignorant to some of these things and ask the quote unquote dumb questions, right? But historically, and these are rough numbers, George, right? On any given year, there's 5 million plus or minus sort of existing homes sold, and maybe about 500,000 new construction homes sold on any given year, as a rough average, right? You said something very interesting, right? Which you said that multifamily housing starts are down, which I think makes sense. But single family, though it's challenged by land prices and construction costs and labor, you said something about 1 million homes. So the new construction market for single family homes has reacted right to this low inventory situation, and they're building like crazy, it sounds like. So are we going to see 1 million new homes sold this year?
So that's really the way the number gets reported, right? Is at the annual pace. So during the month of August, the pace at which builders were putting up homes was indeed a pace that would put us, to be at 1 million for the year. The big question mark here, of course, is will builders be able to maintain that pace, especially when you look at markets on the West Coast that have been really contending with dramatic fires. I mean, I don't know that I remember ever seeing fires quite this extensive geographically, and the intensity and the magnitude which we've seen this year. That's obviously hampering some of the construction there. And also, we're now headlong into the traditional hurricane season, which is already impacting the South. So these are obviously factors that could potentially impact that annual pace, and we may or may not hit 1 million. But ultimately, even if the number is not necessarily at or above 1 million, to me, it's important to recognize that builders are seeing the tremendous potential. If anything, the shortage of supply is not a new story this year. We've been contending it for almost the last decade. As we saw as a fallout of the last recession, where we had so many builders exit the market permanently. We have fewer builders, they're more concentrated. So obviously the dynamics of the market are not so strongly pushing towards build at any cost. So builders have been very disciplined. But that being said, obviously this year accelerated that shortage. So to me, seeing builders respond to that is an important indicator that we're on the right road.
Yeah, no, that's really helpful, George. That makes a lot of sense. Okay, so we're in a situation today, right, where we have again historically low mortgage rates, but as you said, because there's such limited supply, it's driving prices up. I mean, median list prices year over year, like you said, up 10, 11%, $350,000. That's insane, right? It wasn't that long ago that number was in the mid to high 200,000s, and so that has a massive impact on affordability. And as new inventory comes into the market, that may help that a bit. Rates are still low. Like, how does, if you're an agent right now and you're looking at, we're in September, the month's going to be over before we know it, right? Some forward-looking agents are starting to think about, well, what is 2021 going to look like? Frankly, I think most of us are looking towards 2021 at this point. How should they be thinking about what next year is going to be like? How should they be planning? The migrations that are going on in rates and inventory, there's just a lot of pieces to this puzzle. How do you look at 2021?
That's an excellent question. And to me, what's important to keep in mind, and I think we got a very good perspective on that this week. The Federal Reserve's Federal Open Markets Committee, which is the committee that sets the short-term rates, the funds rate for interbank lending, met, and basically their announcement came out of that meeting was very interesting. Number one, they said they obviously will keep interest rates at what they call the zero lower bound, right, around 0%. And not only will they keep them low, but now they've really given a much clearer time frame. They said they'll give it for an extended period of time, likely right now going into 2023. In a sense, looking at policymaking from the Fed, that's unprecedented to have such a long, clear timeline for monetary easing. And furthermore, the Fed said because it's concerned about the pace of economic recovery in light of continuing concerns about the coronavirus. They are continuing their purchases of treasury bonds as well as mortgage-backed securities, both of which are meant to continue infusing capital and liquidity in financial markets. For housing, this, to me, in short, it tells me that mortgage rates are likely to remain fairly low for a longer period. And specifically to your question about 2021, I expect mortgage rates to be low in 2021. On one hand, for agents, this is great news because it tells agents that a lot of buyers who may be being pressured this year to try to find a house in a hurry can ease back a little bit, continue looking because they likely have time on the financing end. And on the other hand, for a lot of agents, obviously that can be a sort of a two-edged sword in which, well, if there's no hurry, I can take my time.
Exactly.
So I think to balance that out, it's important to recognize that buyers are actively in the market this year still. And so for me, 2021 tells me that at the current pace of economic recovery, which frankly is showing signs of slowing down, we saw retail sales for August come out this week, and retail sales were up for the fourth consecutive month, but the rate of growth substantially slowed. It was only 0.6%. We look back at June, July, the rates were much higher, so there we're slowing down. You look at the unemployment insurance claims, right? A weekly indicator of how many people are still filing for unemployment benefits. The number improved, but it was 860,000 for this last week. Just think about it. That's a huge number. Historically, normally we average about 250,000 new claims a month. That's roughly the rate at which people lose jobs. A week ago, we still were close to 900,000 Americans losing jobs and having to file for claim for benefits. And the number of those still unemployed, continuing to draw benefits, was basically over 13 million, which, 12.6, close to 13 million. But what's significant for a lot of people who filed early in the year, right, as the recession set in, some of these benefits have expired. So it doesn't tell us the whole picture. So again, back to agents wondering what's 2021 going to look like. From my perspective, I see continued economic recovery, though really at a slow pace, especially depending on what happens in the next few months as we move towards the tail end of the year. And crucially, the retail season, and we can chat about separately. But on the housing front, there's such huge demographic tailwinds in the US housing market that I see continued growth. And what do I mean by that? And we chatted about this before. We have the largest cohort in history, obviously the millennials, coming of age. This year, we have 5 million of them turning 30. Next year, we have roughly another 4 million. We'll have about 4 million, turning 30 for about 3 or 4 years, which to your point about, home sales in a given year, about 5.5 million. It tells you the magnitude of this cohort. So to me, that's a real positive. And what's more important, this generation has very similar values with prior generations, where we were worried that they're never going to own a house because they're going to rent everything. Yes, when they were, as we chatted, if they were 25 and single, made sense. Many of them now have families. They have 1, 2, 3, sometimes more kids. For them, obviously, a house is just an important consideration, along with schools, quality of life. And I think this year specifically for many younger people, the shift towards lower density housing markets has absolutely accelerated. And I see that trend continuing for certain in 2021. So for agents who are particularly active in suburbs, in mid-sized small towns, this is a real boon because it tells them there's going to be demand for homes in these markets. Simply make sure you connect with these buyers because they're in the market, and understand what they're looking for, right? Now that we as we mentioned, work remotely and interact so much more in our homes, obviously homes that are coming to market ready to sell, whether they have home offices, whether they have space adjusted for remote work, these are all beginning to play an important role in today's market.
That's great. You're so not only articulate about these things, you know your numbers, but I think you present it in a way that is really easy to understand. But to that point, let me ask you a question. Let me ask you to turn into Professor George for just a moment here. I had a conversation with a top loan officer who's a regular on the show. His name is Eric Mitchell, and one of the things that we were talking about is the impact on mortgage rates as it relates to what's happening in the stock market, whether it's good or bad, right? So somebody's propensity to put dollars there versus into, let's say, mortgage-backed securities, bonds, other things like that, as well as inflation. And so, if you don't mind, we didn't talk about this ahead of time. I think it's an important thing that most people don't understand, right? They look at, the Fed's meeting, what's happening with rates, and that's going to change. And it's not unrelated, but it's not totally related either, right? So could you take a stab at helping, I'll just say help me understand better the impact of the stock market and inflation as it relates to mortgage rates?
Absolutely. And let's start, in fact, to your point with the Fed, right? So what the Fed does, and a lot of people, I think, conflate the Fed's funds rate with mortgage rates and assume that they are, in a sense, to your point, tied together. What the Fed's role is in simplistically, mind you, is to provide funding to the financial system. So what they do, they provide liquidity to banks, and then those banks in turn obviously make money by providing loans. In a very simple way, the interest rate that the Fed sets, the short term, it's an overnight rate, very short term. What it does, it lowers or increases the cost of money for banks, right? So if for example, as we see now, the cost of money is close to zero, what it tells banks is they have a lot of latitude in making loans, which is how a lot of money enters the economy. Companies, consumers, they borrow money, they go purchase things, make investments, and then so the engine continues, right? So that's what the short-term rate does. In a sense, it stays focused on keeping banks in the business of lending. The other hand, to your point about mortgage markets, they are indeed tied somewhat to stock but more importantly to bond markets, right? Because in a sense, mortgages are bond obligations, and so what you end up here with is a different set of conditions. Generally speaking, and historically speaking, bond investors drove the rates for mortgages. And when you look at bonds, you have investors that look at everything from government bonds to municipal bonds to corporate bonds to mortgage-backed securities, which are the instruments that underpin so many mortgages, right? And so when investors look at the two major categories traditionally, there were stocks, the equity markets, and bonds. If you wanted to see lots of growth, you would put money in the stock market. Yes, you recognize there's volatility, but generally speaking, the rates you get in return are commensurate with that. On the other hand, if you're looking for income, a lot less volatility, more stability, you'd put your money in bonds. Or conversely, you do a combination of two. So for the stock market specifically, what we're seeing today, in light of a really volatile stock market this year, and yes, I recognize, tech stocks have driven the market to new records this year, but there's a lot of concern about the pace. Some investors are concerned there's overvaluation and so on. So with that in mind, investors have become more conservative and continue putting money in bonds. As a result of that, the mortgage market has benefited tremendously because a huge chunk of the bond market is taken by mortgage-backed securities. In addition, this year, as a result of the pandemic and the recession that it induced, the Federal Reserve played a much more direct role. Traditionally, the Federal Reserve did not participate in the bond market, buying bonds like any other investor, except in times of dire circumstances, like during the last recession. Because the Fed's concerned over the potential impact of this recession on the economy, the Fed is now actively purchasing both corporate, government, and mortgage-backed securities as an active participant, which is further supporting rates. And again, to your point about discussing a little theory, mortgage rates generally tend to be inversely correlated with demand. So the more demand, the more investors want bonds and mortgage securities, the lower the rates go. And the fewer investors are interested in bonds, the higher they go. So the Fed, recognizing that, is why they're playing such a major role, along with all the other investors, in keeping rates low by continuing to purchase these bonds. So that's why I say, in light of the Fed's moves, along with obviously the broader capital markets, I expect mortgage rates to remain low even into next year. To me, a real concern would be if somehow the housing market saw a decline, because at that point, a lot of investors who put their money into mortgage-backed securities might consider pulling money out of that, which could increase rates. And so the fact that we've had a very strong rebound in the housing market, I think is signaling to investors that the market still has a lot of legs beneath it and likely to maintain the space into 2021.
That's extremely helpful, George. Thank you for that. Right. I think you know by now that one of the things that I really want to accomplish with this program and this message is I want people to start to get a much deeper understanding of the underpinnings of this industry. And this is obviously such a critical piece of it. So I appreciate you doing that. There's a couple other things I wanted to touch on today briefly before we wrap up, George. One is you mentioned this, you alluded to this, which is the retail season, right? So we are coming into what is traditionally a free-for-all of spending, right? With, starting from, let's say, Thanksgiving, obviously through the holiday season at the end of the year. What's going on there? What do we think is going to happen? What signals do we see right now? Obviously, one of the things that we saw early during this year was a massive rush towards e-commerce, which made sense, right? Because people weren't going to stores. And I'm going to mess up the stat, so I probably shouldn't quote it, but it was the gains that the online e-commerce industry saw in 3 months were what took them years to accomplish, right? So there was this mad rush. So what's happening on the retail side? You talked about some of the numbers, but what are we looking forward to or not in this holiday season?
That's an important question, and especially so since we're talking about real estate market for the retail sector of commercial real estate, a sector which this year has had a particularly difficult run. We've seen for the last decade, in a sense, after the last recession, when the retail sector took to quite a beating, there's been a lot of what the industry started terming right sizing, right? A lot of store closures, a lot of retail companies looking to shrink their footprint to be a lot more strategic. What this year has done, however, is orders of magnitude, beyond that. The number of retail bankruptcies has been staggering. Thankfully, for many of those, it's just a reorganizational bankruptcy, right? So we're seeing some of those companies, like Neiman Marcus, for example, coming back out of the bankruptcy, looking to be leaner, but in a sense healthier. But for a lot of smaller companies, this has led to a permanent exit from the market, with huge impacts in many mid-sized and smaller towns to their base, right? Everything from tax revenues to people's opportunities to shop. So looking forward to this holiday season, what I see in a way is really going to be dependent on, in a sense, two factors. Right now, we're seeing what economists have been calling the K-shaped recovery, right? So on one arm of the K, which goes up, we're seeing people who still have jobs, have been able to save money, obviously, without having to commute, without eating out, save a lot of money. And so there is a pent-up sort of feeling of wanting to shop, wanting to, in a sense, reward ourselves for a difficult year. So I think that side of the retail market may do very well come December. On the other hand, the lower arm of the K, we're still seeing millions of Americans who are unemployed, are dependent on unemployment benefits. And in there, many of them have lost the enhanced $600 a week benefit. The administration obviously made an effort and pushed some of the FEMA funds to provide states the ability to issue $300 a month. So that, I think, has helped. But for those folks, particularly if they don't have holdings, whether it's stock, bonds, real estate, they're really dependent on either savings or their income. And so for a lot of those folks, it's very likely that this holiday season may be a lot more difficult. So to your point, I see the big winners of this holiday season continuing to be the e-commerce, staples of this year. In fact, you're right, we've seen Amazon announce they're looking to hire something like 100,000 workers over the next few months in anticipation of that. We've seen Walmart really step up its game in pushing to basically get so much closer to the Amazon's last mile logistics and be able to deliver on time and within a framework of what they expect are for almost over 90% of their orders, which is tremendous. We've seen some of the other players like Target come out very well through this. So I think for a lot of these traditional players, this will be a good year. We might even see a slight bump up from retail sales a year ago. Uh, but again, that to me comes under fairly large caution. Obviously, it really depends. Since we're in September, we got really 2 more months of economic activity. And so a lot can happen, as we learned so far in the year, a lot can happen in these 2 months.
Yeah, no, that's really interesting. And George, just to go back to the type of recovery, I remember having conversations, 4, 5, 6 months ago, right? People were debating whether it's going to be U-shaped or V-shaped. There's all of these different shapes, and I don't recall hearing any prediction about a K-shaped recovery, but it makes a lot of sense, and I think that's something that a lot of us, and frankly, I imagine a lot of the people that are watching right now feel very viscerally, right? I feel very grateful to be on the right side of that K. I feel very lucky, and there are millions of people, to your point, who aren't, right? And so there is that sort of fork and that bifurcation of what people are experiencing in the world right now, which is incredibly sad and incredibly tragic. And you mentioned the FEMA funds, but obviously there was no sort of extension, right? Sort of widespread extension of the extended unemployment benefits, and so we're going to see how all of that shapes up. I guess one last piece of this, George, if you don't mind, and I appreciate all of your help and guidance and input here. It's tremendously helpful. Is on the forbearance side, right? And maybe this is not a big update at this point, but would like you to just touch a little bit about what's happening on forbearance. And now that I remember, if you don't mind touching on one other thing, which is not totally related, but not unrelated, is I didn't get a chance to read it yet, but I saw a headline this morning about predictions for GDP, and that they were actually more positive than we may have expected a few months ago. So if you don't mind, just touch briefly on those two things. I think we can wrap, and this is a really good overview of the market right now.
Absolutely. So let's start with GDP, in part because indeed you're right. The expectations for next year, and most of those are based on what has happened so far this year, right? Most forecasts tend to be, in a sense, dependent on a rear view mirror. But that being said, what we've seen, particularly after the end of the second quarter, which was dramatic, right? That the drop was significant. We've seen broader economic, whether you're looking at manufacturing activity, whether you're looking at industrial production. In fact, this week we had industrial production numbers come out, and the industrial production was up for 3 straight months, right, ending in August. Yes, similar to retail sales, we're seeing a moderation in that pace. But really, manufacturing carried the industrial production index forward. Car production was down, mining, energy, gas was down. But on balance, we are still seeing job creation, we are seeing economic output increase. So I think for many economists, this spells a potentially much better third quarter. And if that's the case, we are likely to see, obviously, some of that momentum carry forward into 2021. So I think really that's what a lot of the positive forecasts are based on, along with, and I think I would not underestimate this by any chance, with the commitment that the Fed has put into so much monetary easing. It's really hard to fight with free money, or fight against it. And so when you have all this liquidity sloshing around the economy, at some point, it's obviously going to provide some help. I do think, and just to kind of go back to our prior question, that on the fiscal side, we could have benefited from an additional slight boost, more targeted towards consumers this time. Congress, during the CARES Act, put a lot of money towards those benefits, and I think that's really what has carried a lot of Americans through these difficult times. And I think there was a lot of concern over debt for the next stimulus act. The thing is, you could have achieved something even on a smaller scale, just be more targeted. And ultimately, companies have been very well, in a sense, endowed with capital. So it's been consumers mostly that could have probably used some of that help. But on balance, this is what is driving so much of the outlook for next year. Now, jumping to the forbearance question, what we're seeing is really in terms of data, and there are several companies that track this performance in lending. And so depending on which data you are, rates are down near 7% for some, closer to 10% for others. But it seems that the trend is absolutely improving. So there is a widespread decline in loans in forbearance. I think some of that is really a direct result of the fact that early on, lenders from the regulatory side worried about being penalized for not helping homeowners, put a lot of people into forbearance, many of which probably were not, didn't necessarily need to be there. But now that we are basically towards the tail end, almost at the end of this month, we'll find out we're at the tail end of the first 180-day period. As you remember, there are two of those periods that homeowners have. So it seems that many homeowners have been current on their mortgages. To me, what is a little bit concerning, and we've had some data companies that pointed this out, is the number of delinquencies in the latter stages. So 90-day, 120-day delinquencies are really beginning to rise. So this tells me that within the broader context of high unemployment, a lot of homeowners might still be looking for jobs if they lost it. And so for a lot of those homeowners, this is still a pretty treacherous time. The silver lining to this is that at the end of this month begins the second 180-day period. So for many homeowners still in distress, they can work with their lender to basically extend that period. Unfortunately, as I saw this week, to your point about headlines, I noticed this week that there was an estimation that at least over 1 million homeowners are falling through the cracks of the forbearance program. Some of them because they do not know they have this as an option. And so I think for obviously for lenders, but I think even the broader real estate community, this is something worth focusing on. If there are folks who may be in dire straits and they're not aware, I think it's worth obviously informing these people that the program is available. So ultimately, we won't really know fully how successful the program has been until really next year. Though I think come October, we'll get a first indication because half the period will have elapsed. And so we'll have a much better indication now. From my perspective, I think the program has already been a success. Just think about the fact that in light of the tremendous unemployment numbers we had in the first 4 months, right during and after the pandemic, we would have had millions of homeowners possibly lose their homes. So the fact that we avoided that additional pain, to me, is already a success. So it remains to be seen how we fare over the next 6 months.
Yeah, no, I would echo that. I mean, I remember having what felt like doomsday conversations at the very, very beginning of this with lenders who were like, I don't know what we're going to do, and everybody sort of lined up and they worked things out, and I think that was a tremendous success. And the other thing, of course, as you know, is that unlike '08, there's trillions of dollars in equity, right, that people have. I mean, there's more equity now than ever before, and so that gives people a lot of optionality, I think, that didn't exist. And I say that only because I think that simplistically, and this is a natural behavior as we look at a moment like this and we look for some reference point, right? And I think the most recent reference point that we all have is the '08 crash. And it's like, okay, oh my God, is this going to be that again? And when you look at the equity position that homeowners have, which is completely different than it was back then, and you look at all of these things that you're talking about, I think there's hope for those out there who are afraid of that there's some positive signs. Clearly there's challenges right now for people who are on the bottom side of that K. Clearly there's challenges for people who aren't but are really trying to find a home and are really struggling because there's not enough inventory. But it sounds like there's a lot of positive signs in general for the industry, and I appreciate you sharing that broad perspective on what's going on.
Absolutely. And I think you made a very good point, and I think it's worth highlighting. Homeowners' equity is absolutely at record levels. In addition, about 37% of American homeowners own their house free and clear. They don't have a mortgage, which is to me tremendous, right?
That's amazing.
Yeah, it is. When you're facing a downturn in the economy, having the peace of mind and the financial stability to know that really what you owe on your home is confined to property taxes, right, and
Yes.
your utilities in a sense. is tremendous. And so with the current market, even folks who are looking possibly at not being able to meet their financial obligations, the fact that the market right now is so hot in a sense provides some homeowners the option of actually selling the house without taking a loss, which obviously is not a place anyone wants to be in. But to your point, look back at 2008 when so many people had put their life savings as a down payment, were paying on their mortgage, but eventually couldn't keep up because they lost their job. They had, in many cases, overpaid for a house that after the crash was not worth nearly what they had paid for. And they ended up losing everything, right? So for me, the fact that in today's market, some of those homeowners have the possibility, though they might not want to actually sell the house and, in a sense, recoup at least all the principal they put in, down payment plus all the is tremendous, because instead of wiping them out financially, it provides them an exit strategy that's a lot more palatable.
I think it's great. I think it's great. Awesome. Well, George, as always, I feel like I can talk to you forever, but I suppose we should probably wrap up for today, let you get back to it. But George, I just appreciate you doing this and taking the time. These are important messages. These are important topics for people to understand, even if it feels a little bit scary. And we'll keep at it until everybody understands what we're talking about, because it's just so critical.
Absolutely. Always enjoy chatting with you, Randy, and I'm hoping that agents and anyone listening, they get some good value out of this.
They absolutely will. All right, George, we'll talk to you real soon, I hope. Thank you.
All right.
All right. Well, there you have it. I just love having George on. He can answer any question you throw at him, and I think he does it in a way that's easy to understand. While we're here, again, check out Realtor.com on YouTube. There's some great content there. Subscribe. Realtor.com/research. Again, these links are below. Definitely go here, right? I can't stress this enough, right? Understanding the underpinnings of this industry as it relates to data and things that I know may sound a little bit scary are really critical if you're going to make the right choices for your business. And again, here down on the bottom of the page, you can sign up and you can get on that mailing list and get access to these reports and build this into your routine. Look at this information and data. If you have questions, ask them right here on this channel. Like, just put a comment below and ask questions, and we'll do our best to answer them for you. So thanks for watching today. Until tomorrow, be safe, be healthy, be happy. Start learning this data, subscribe and learn, and we'll talk to you soon. Bye.